The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, what in the wheat happened on Wednesday? I think that's the big question we got to answer here during our market analysis on today's show. It was a down day, double-digit losses in all three classes of wheat, and row crops were mixed to lower, maybe got some influence from the wheat trade. We had another down day in cattle and hogs as well. Just a lot of red, a lot more red than I'd like to see on the commodity screen at midweek. Joining us now for a conversation as we look at things, Mike Zuzolo with Global Commodity Analytics is with us. Mike, happy to have you on the show. And man, oh man, wheat doing wheat things. I don't know. I can't make sense of what we saw on Wednesday. Just not a great day to take a look at the commodity screen, Mike.
We're all searching and we're all feeling our way through this, Jesse. I think the theme of today's program could be from a previous Seinfeld episode with one of my favorite actors, Lloyd Bridges. He was the guy that ran the airport on the movie Airplane. And he was in a Seinfeld episode, and he was always challenging Jerry Seinfeld to stuff. And he'd always say, it's go time. Well, it's go time for the wheat because we've hit some levels we simply cannot go below at this point, in my opinion. And we shouldn't have to if the analysis I've been doing has any accuracy to it and has any timeliness to it. And what I mean by that is, if you recall what we talked about, the two major sources of the wheat-led rally back in April, May was supply demand. It was Russia, and it was also USDA coming in with lower WASDE numbers for the corn especially. That was one. Two, and probably the biggest part was the outside market force of the funds coming in and buying commodities in the inflation buzz in the emerging market turnaround, thinking that we were going to see commodities and emerging markets really kick into gear. Why? Because the bond yields were tepid, the Fed was going to be neutral, and China was getting stronger. We've lost that part of the marketplace, and we knew at the end of May that we needed, because of the seasonals and Northern Hemisphere harvest, we knew that 2009 model year that you and I talked a lot about, led by the wheat, was probably going to have a lot of help from the crude oil and have a lot of help from the dollar. And exactly the opposite has happened. We've actually been hit by the dollar, and we've been hit by the crude oil market. And so with the prices now today, I think today's show, what we're going to help hopefully show is why we need to change this dynamic right away, essentially.
Well, let's look at some of the charts and some of the correlations here and talk more about this. And we'll start with a WTI crude and SRW wheat chart and set this up for us. You talk about being go time. What are you seeing on this chart right now, Mike?
Yeah, you notice in this chart between the two, and the very bottom red line is a 10-week correlation in price between the two, and they've actually gotten very sharply negative with one another in the last 2 weeks or so. And that can't hold, in my opinion, Jesse. Either the crude's got a bottom or the wheat's got another leg down in it, because when you look at the big picture, essentially since 2018, other than a few hiccups, these two markets really work well with one another. Typically, crude will put the low in first and the wheat will put the high in first, based upon my experience. That's not a foolproof thing, but they work really well together. The same could be said about the wheat and the soft red complex and also the copper market. Well, the wheat and the copper and the crude oil markets, hard red wheat specifically, have had about a 10% pullback from their highs on a weekly basis or thereabouts. And so it's really time at this stage of the game for the crude oil market to bottom. And if it does, then we can see, I think, the wheat market have a reason to find a bottom as well, along with the fact that just today in the morning trade, Sovecon came out and took their Russian wheat production down to 80.7 million tons. That compares to USDA's 88 million metric tons. So if you're a bear out there thinking that the U.S. wheat crop's going to get bigger because of the harvest and because of the quality tours that we had a month or so ago, and it's going to get bigger because Australia's gotten some rain, that's fine. You can push that a little bit. But if you're talking about a substantial decline in both Ukraine and Russia, I don't think there's anything out there that would say net we are building supplies. I think we're still losing supplies globally, and I think the weather really does show that very clearly. So that's why these macro markets mean so much to me right now.
Well, let's lean into that weather a little bit here. And you mentioned Sovecon, and I think what at this point from their March estimate, there's some 10 million, over 10 million metric tons lower now. And to me, I was surprised that that didn't give us much support. It felt like on the day Wednesday, considering the weather situation, we still fight in Russia and Ukraine.
Yeah, I think you're right. And I think this is, I think, a combination mainly from those outside market commodities. But I also think the rhetoric today and yesterday in when dealing with the Black Sea was very suspicious in my mind. In other words, Russia came out, in the middle of the day, roughly trading day of today on Wednesday, and said this is a person that was in charge of Rus grain that is a big exporter for the Soviets, or for the Russians, I should say. He said, we don't expect strict restrictions on exports, but the reduction in our supply to the world markets is quite possible. We'll probably see be less flexible on prices, recognizing the limitations of our supply. You had that, and you had a couple other pieces of information out there floating around, making the market wonder, well, have we overshot the mark on the upside? Well, this map, I think, helps understand where we're at. The key drought area, and by the way, this is a 5-day precip forecast map from one of the people I purchased information from. This was yesterday's map for the 5-day precip area. Notice how dry it is in that key square of the drought area that I've put as a key drought area. Today's model for the 5-day was even drier, and some of those key areas, like where the blue dot is close to the Black Sea, all the way up towards Volgograd, they're going to be 94, 95 degrees today, and tomorrow they're going to cool off, and then forecasts are they're going to be back to 94, 95 next week. The small in the bottom right corner, the reason I call that the drought area is because I looked at the crop moisture models and the drought severity index from the CPC, and I embedded that little map, and those oranges and reds are exactly what we're talking about for Russian crop belt. And I'll just leave you with this on the weather, Jesse. The Russian and center west Brazil areas of the wheat and corn belts of Russia and Ukraine and Brazil, the soil moisture profile in some of the key provinces that grow most of the crops, they're the lowest in 7 years when you look at soil moisture and some of the satellite imagery based upon where they're at, where they should be. 7-year lows right now in terms of moisture levels. So that's why I feel like that we're not really trading a lot of supply demand.
Well, let's wrap up our wheat discussion here today, and we'll look at a weekly chart for SRW and kind of wrap this for us here in terms of where we go from here. And I know, too, in the U.S., we got winter wheat harvest starting up, and spring wheat ratings have looked pretty good so far. So maybe some of that's thrown in here as well as like an added bearishness maybe to some things possibly midweek. I'm not sure, but your thoughts on this chart and some of those thoughts as we wrap up the wheat side of things.
Yeah, I'm glad you brought that up, because this is where gravity takes effects this time of year because of the seasonality of the northern hemisphere harvest. Very, very quickly, this weekly SRW chart says to me, okay, we've broken the backbone of this market of the last 6-week rally, and we left a gap at 606 from about 5 weeks ago. And I'm really nervous that if we take out the 640 area in soft red wheat, we're going to go chasing after that gap just above $6. And then we've got a major moving average that we had not been above on a weekly close for essentially 2 years up until 7 weeks ago. That's right around 590. That could be our final resting place if this market doesn't turn around pretty much right away. And that's especially the case given the fact that the stochastics, the white and orange lines that I try and optimize for buy and sell signals, they are giving us a sell signal this week now. And we've got to negate that, in other words.
We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk, and you talk about macro markets. I'll pull up this U.S. dollar chart as well, and just thinking about the dollar and some of those other factors you mentioned earlier, like crude, et cetera. I mean, obviously the outside markets, we've been getting a lot of different data that's been an influence here the last week or so. I believe we've got PMI data updated on Wednesday as well. I mean, Talk about the macro picture here a little more for us and what you're seeing in terms of the dollar and how that's affecting things.
Yeah, this is an interesting dynamic because this is a monthly spot dollar index, and you've got that blue wedge in that market, and we broke above the point of the wedge before the apex, and we I think broke early to the upside. I'll be interested to see now if we don't come back to the point and actually go below the support line and head towards that major moving average of 101.20. The reason I think that's possible, Jesse, is because, as you say, the data, economic data here in the United States has been soft enough, and the Chinese economic data, like their PMIs for manufacturing and services, have been strong enough. I could see why the trade would want to go ahead and sell their dollar positions at this point, halfway through the calendar year, because I do think that the likelihood of a Fed rate cut is back on the table this fall. And that was the major reason, along with fears of China's economy, as to why I think this dollar has been treated as a safe haven. So I would not be surprised. In fact, I think it could be more likely than not we could unwrap that philosophy, that fundamental sentiment in the dollar. And if that's the case, let's watch this chart real closely.
In terms of the row crops, I'll start with the soy complex. We got a chart looking at the November soy seasonal here that you can walk through with us. And really, soybeans, this whole complex has had me the most concerned, I would say, as we've gone since Memorial Day. I know bean meal was a bit higher on Wednesday, but just the overall trend in soybeans, I'm a little more worried there than I am in corn. What are your thoughts on the soy complex right now, Mike?
Well, I think you should be, because I am too. This chart shows us some of the analog years that we've been running similar to, and 2023 and 2014 really stand out because of where we're at in price, as well as how we've trended ever since the middle of April. What I don't like about the soybeans, and what the trade is catching wind of now, is the idea of prevent plant in corn, going all the way up into Wisconsin and parts of Iowa, heading all the way down to southern Illinois, as I believe today, actually June 5th, is a big swath of corn prevent plant date starts now after the June 5th calendar date goes away. And I think the trade could really open up the downside in the soybeans here. This chart essentially shows you we're going down like 2014, then we went sideways, and then we went down another leg and really never looked back until September. And unfortunately, I'm nervous, just like you are, that that's where we're headed, especially if the trade really does think we're trading and swapping out corn acres for bean acres. Some of my clients in southern Illinois are doing that right now. So I think it's a real concern we should have, and that puts more onus and pressure on the wheat and on the soy meal and on the corn to turn the tide and give the beans some support here.
Well, and thinking about swapping out some of those acres, I've heard that same chatter as well. I wonder if it's going to be enough of a shift to have massive impacts. But again, hard to say. Time will tell there. Corn, to that extent, it's kind of still sideways, it feels like. But this corn trade, too, just can't seem to find a bullish story to kind of hinge on. And we've gotten ourselves down near some support levels like 459 D's corn on the close, for instance, Wednesday. I mean, these are areas that, I think a lot of farmers would like to see us bounce off this a little bit, at least, Mike.
Without a doubt, this is, again, a very critical area for the corn. And it goes back to, for me at this point, Jesse, the corn and the live cattle have the best cash market support. They have the tightest supplies compared to their peers in the grains and the livestock sector. And you see that when it comes to some of the price action that we're seeing out in the cash markets. And so I think the safety net, or the support and the floor underneath corn and live cattle, is best. But that doesn't mean they can't erode in price. And it certainly doesn't mean they have to rally because of positive supply-demand fundamentals. So this is where, to me, the corn market, when I saw the crop conditions report, it's 75% good to excellent, I think it was. That said to the trade, okay, we're on track for a 180 plus yield. Having said that, we've got the three I states still 6 to 9% behind last year, in corn planting. And I do think that we're going to swap out some corn acres for soybeans. So I think the trade's being very respectful of corn. I think they should. I think another sleeper for the corn could be yet another WASDE report coming up here in about a week again by USDA that says, okay, we are losing in both Argentina and Brazil more corn production. I feel like that's what's happening.
I'll be interested to see that WASDE report as well coming up next week. That is going to be key. You brought up cattle, and let's talk cattle. Pull up our final chart on the video feed, August cattle chart, and you look at Wednesday's action, live cattle particularly, a little bit lower, not too bad in futures. Cash activities still pretty quiet this week. In fact, northern asking prices are out there before southern. Don't see that all the time.
No.
Your thoughts of the cattle trade here midweek, Mike?
Yeah, I mean, this goes back to if you're not used to listening to you and I, well, at the end of the day, what my job is to pick prices and do my independent research and give a value level analysis of what I think is a good price to sell at, what I would call overvalue if you're a producer. If you're buying an undervalued price of what you should, I think, be a value level that is kind of discounted. And so this is my new August live cattle value level chart that I sent out to clients last night. The USDA has a 182 Q3 average steer price to it. And so I'm using August for my Q3 numbers. We're going to see probably about a 200 million pound decline in Q3 commercial beef production versus Q2. And I think that supports the market, kind of like what we were talking about with the corn. The upside potential, though, Jesse, I think is going to be limited by the retail prices for beef and for ground chuck. Another chart that I'll be sending out along with your video tonight to the clients and subscribers that is kind of a pay-per-view type chart is the actual retail prices for chicken breasts, pork chops, ground chuck, and steak all together. And you're looking at chicken breasts at 406, having dropped pretty substantially recently, pork chops at 433. Sideways, and then you've got ground chuck prices at almost $7. Average U.S. city steak price is about $10.75. When I looked at these numbers, it said to me, don't bet on the idea that you can get futures much above USDA's average cash price of 182. So you get above 183 and a quarter, you start moving pretty aggressive, just like the above 12.25 in November beans. You move pretty aggressively. So that's where I'm at on the cattle markets as we head into the deeper part of summer.
Well, I'm thinking about some of those retail prices and demand as well. I'll use that as my cheap segue to the hog market, which I just cannot seem to find a rhyme or reason. This hog market just seems to lack the technical support to hold some sort of a bottom here. I just feel like we continue to see triple-digit losses in hog futures here since Memorial Day, Mike.
Yeah, and this is where it goes back to what can make the market rally. And I see that the grains and the meats are coming together in that one major thing. It's really the crude oil market and the dollar. It's really about the dollar weakening and the crude oil market strengthening and bringing the funds back, bringing the exports back. And I think hogs are right in the middle of that. Chinese hog prices are actually going up right now, Jesse. And I think the cutout market is going to stay relatively firm at about $100. But the funds can play in between now and July 4th, I think. And I think that's where the funds can overdo it to the upside and overdo it to the downside. This may be one of those times where they're overdoing it to the downside in the hog market. And especially as we get closer to that BLT season when tomatoes come on here, I think that might be a positioning area where for some clients, I might be looking at the long side of the hog market.
Mike, final thoughts from you? Anything else you want to add or mention to folks here today?
No, I think the key is the next WASDE report as far as what I do at my desk, as far as whether I'm right or wrong. If the funds don't come in and buy this market and cover shorts led by those macro markets, I'm going to have to rely more upon supply demand. And if I don't get a good bullish supply demand report from USDA, I'm going to have to make hedges on paper to probably protect myself from more downside. So it really is a crucial week now that we're in the month of June, Jesse.
Well, Mike, if folks want to contact you, take a look at your independent analysis and talk markets, I know they could find you online very easily. How can they get a hold of you?
GlobalCommResearch.com, GlobalComm with 2 M's, research.com. Sign up for a 2-week free trial.
Fantastic. GlobalComm with 2 M's, research.com. Mike Zuzolo, Global Commodity Analytics, Always good to talk with you, my friend. Have a great week. We'll talk to you soon.
Thank you, Jesse. Great to be with you.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.